The Federal Reserve is paying your bank over 4% interest, guaranteed, risk-free, on the exact same cash sitting in your savings account. And your bank is paying you 1 cent per $100. This is not an accident. This is a system.
Imagine lending your neighbor a lawnmower for free, and they immediately rent it out for $100 a day. That's modern banking. Mega banks pay you 0.01%, but charge over 20% for credit cards. This gap generates over $1 trillion.
They rely on something called a loyalty tax. It's a calculated mathematical bet that you are simply too busy to move your money. These banking secrets rely entirely on your inertia to fund their towering skyscrapers and record-breaking profits.
So, how does this actually work behind closed doors? Remember that single penny from the lobby? To understand why they keep it, we need to look at the single most important metric in finance: the cost of funds versus interest rate.
Your savings account is technically a loan you make to the bank. Their cost of funds is what they pay you, practically nothing. The net interest margin is the massive profit they make when they lend your money out.
But they don't even need to lend it to consumers to get rich. Enter the IORB, interest on reserve balances. The Federal Reserve actually pays banks a risk-free yield just to park cash overnight.
This is the ultimate arbitrage. The bank takes your deposit, pays you 0.01%, and instantly hands it to the Federal Reserve to earn over 4% risk-free. It's like buying $1 for a penny, guaranteed by the government.
Think of it as a frictionless pipeline. Your money flows in, gets instantly marked up 400 times in value, and the bank pockets the difference without taking a single risk. The house always wins.
But wait, when the central bank raises interest rates to fight inflation, shouldn't your savings rate go up too? Why do your credit card rates skyrocket instantly while your savings account barely twitches? The answer is a hidden metric called deposit beta. It's a formula banks use to mathematically decide exactly how much to shortchange you. They practice asymmetric rate transmission, lightning fast to charge you more, painfully slow to pay you more.
Why do they get away with this low deposit beta? Because mega banks simply do not need your money anymore. After the 2008 crisis, central banks flooded the system with excess liquidity. They already have too much cash.
This is why online banks frequently offer high-yield accounts over 4%. Without expensive branch networks, they actually need your capital to grow. Traditional banks don't, so they intentionally leave everyday savers to foot the bill of inflation.
Has it always been this bleak? Let's do a quick callback to that 4% the Fed pays today. In the early 1980s, the financial landscape was entirely flipped. Savers weren't ignored, they were fiercely courted.
In 1980, to combat runaway inflation, the Fed hiked rates to 20%. Because banks desperately needed capital to fund loans, they passed those massive rates directly to the public. A standard 3-month certificate of deposit paid a staggering 18.65%.
So what killed the golden yield? The 2008 Great Recession. To save a collapsing economy, the Fed slashed rates to zero. Savings yields plummeted from 5% to practically nothing. It was supposed to be a temporary emergency measure.
But banks realized they loved the 0% cost of funds. The temporary emergency became a permanent business model. Even when inflation returned and rates went back up, the golden yields of the 80s never returned to traditional banks.
This permanent wealth transfer is exactly why savings rates are low today. The system is functioning exactly as designed, weaponizing your loyalty to subsidize their risk-free profits. Your inaction is their greatest asset.
The only way to break the cycle is to move your money. In the world of personal finance, loyalty to a mega bank doesn't pay. It literally costs you. Take your pennies back and stop funding their skyscrapers.